Overconfidence bias. Why your big win might be your greatest risk. If I asked you right now, are you an above-average driver? What would you say? Statistically, about 80% of people say yes. But mathematically, that's impossible. Only 50% can be above average. This is the overconfidence bias. In our daily lives, it gives us the courage to start businesses and take risks. But in the stock market, it's a silent killer. It's the voice in your head that says, I know something the Wall Street experts don't. Or, I have a feeling about this one. Today, we're peeling back the ego. We're going to look at why your lucky trades are actually dangerous, why the most active traders usually make the least money, and how to build a portfolio that survives even when you're wrong. The illusion of knowledge. In 2026, we have more data than ever. We have 24-hour news, Twitter, X, Threads, and AI-powered stock screeners. This creates the illusion of knowledge. We confuse having information with having an edge. The Dunning-Kruger effect shows that people with a small amount of knowledge often have the highest confidence. You read one annual report, watch 2 YouTube videos, and suddenly you feel like a hedge fund manager. But remember, on the other side of every trade you make, there is likely a supercomputer or a team of PhDs with 20 years of experience. If you think you're beating them because of a feeling, you aren't investing. You're gambling with a better vocabulary. The high cost of activity. The most dangerous byproduct of overconfidence is excessive trading. A famous study by Professors Barber and Odin analyzed over 60,000 brokerage accounts. They found a startling trend. The investors who traded the most had the lowest returns. Why? Because overconfident investors believe they can time the market perfectly. They sell high and try to buy low every single week. But they forget 3 things. Transaction costs. Even zero-commission apps have spreads that eat your profit. Taxes. Short-term capital gains tax is a massive drag on your compounding. The timing trap. If you miss just the 10 best days in the market over a decade, your total returns can be cut in half. Overconfidence makes you move. Success makes you sit still. Concentration versus diversification. When an individual investor is overconfident, they hate diversification. They say, why would I buy an index fund and get 10% when I can put all my money in this one tech stock and get 50%? This is called idiosyncratic risk. It's the all-in mentality. While concentration can make you rich, it rarely keeps you rich. Overconfidence blinds us to black swan events, lawsuits, CEO scandals, or sudden industry shifts. The professional investor knows they might be wrong. That's why they diversify. The overconfident amateur knows they are right, so they leave themselves no room for error. When the market proves them wrong, they don't just lose a little, they lose everything. The humility system. How do we fight our own ego? We need to build a humility system. The investment journal. Every time you buy a stock, write down exactly why. What is the goal? What is the risk? A year later, read it. You'll be shocked at how often your brilliant logic was actually just a lucky guess. The 5% sandbox. If you love picking stocks, do it, but limit it to 5% or 10% of your total wealth. Let the other 90% sit in boring, average index funds. This way, your ego can play without ruining your retirement. Seek disconfirming evidence. Instead of looking for articles that agree with you, search for why stock name will fail. If you can't handle the bear case, you shouldn't own the bull case. Conclusion and call to action. The market doesn't care about your IQ, and it certainly doesn't care about your confidence. It is a giant machine designed to humiliate anyone who thinks they've mastered it. The most successful investors in history, men like Warren Buffett, often describe themselves as average people who just followed a disciplined system. They traded their ego for a compound interest table. In our next video, we'll talk about mental accounting, how we treat a tax refund differently than our salary, and how that weird brain glitch messes up our financial planning. If you've ever made a trade you regretted because you were too sure of yourself, tell us the story in the comments. Let's learn from each other's egos. Hit subscribe, and I'll see you in the next one.